All right, a very good evening. Once again, thank you for joining us early this evening. We will be starting the webinar in about 1 to 2 minutes time. All right, very good evening, everybody. It's 7 o'clock now, so we will kickstart the webinar proper. My name is Edward, and I'm from the digital sales team at Saxo Market Singapore, and your host for tonight's webinar. A warm welcome and thank you for taking time off your busy schedule to join us this evening. So before we begin, should you have any questions along the way with regards to the platform or with regards to the content, do feel free to post them on the questions on the website, and we'll try to address them for you at the end of the session. Our webinar will take about 45 minutes, starting from a quick Saxo Trader Go platform walkthrough. We're happy to inform you that today's content is brought to you by Saxo in collaboration with GlobalX. We're very honored to have with us today from GlobalX, Scott Helfstein, Head of Thematic Solutions. He will be touching on the some interesting investment opportunities in thematic solutions, looking into certain long-term trends and opportunities in the current climate. Finally, we will leave a few minutes at the end of the session for Q&A and of course a closing remark as a wrap-up. So to start the webinar proper, we just go through on how you can access the Saxo platform if you do not already know. To access the Saxo Trader platform, you just have to go to your URL, key in saxotrader.com. Alternatively, the platform can also be accessed via the Saxo website. On the top right-hand corner, you can see the login icon. Upon clicking the icon, you can see that Saxo offers a few different platforms for you to choose. They are both available on the browser and as well as mobile applications, whereby you can download on your mobile devices, allowing your trades on the go easily. In the next few minutes, I'll be demonstrating how you can build a diverse portfolio through our award-winning Saxo platform, the Saxo Trader Go. So once you log into the platform, this is what you will see. A main screen layout with a main header bar over here. So today's webinar topic is about thematic solution. Should you be interested to explore thematic and diverse investment via ETF with Saxo, you can take a closer look into the Saxo research tab. Saxo also categorizes these instruments based on their performance and of course the Morningstar rating for your ease of evaluation. For instruments in line with today's presentation, you can also create a screener or a watch list to keep those products in watch. So to create a watch list, you just need to go under the trading tab, under the subsection watch list. On the top right hand corner, there's this new button, and you can actually create the new watch list based on what you desire. So after naming your watch list, you can start adding instruments you desire into your watch list. Saxo offers a wide range of instruments across different asset classes. The watch list is also capable of illustrating the instruments that the platform offers and of course each individual client desire. So for example, if let's say you're interested in today's instrument that we're talking about today, you can actually just use this watch list over here to add in the instruments. So similarly, if you're already looking at an instrument on your product overview, you can select this star icon over here to add this to your watch list. So this is an example of how do you create your watch list. So example of a watch list is like this. So you can add in different types of instruments, including the equities, CFDs, ETFs, the CFDs, ETFs, FX futures, options, and even commodities, depending on your own desire. Moving on to the screener. So again, if you are interested in, after today's webinar, you're interested in what Global X have to offer on their ETFs, you can actually use this screener over here to filter out the certain instruments, for example, ETFs and the issuers. And the screener actually screens out all the instruments that is issued by this particular issuer. So for example, if you're again interested in a certain instruments under this screener, similarly on the right click on this, and you can add this to your personal watch list. So now with an understanding of the Saxo Trader Go, it brings me great honor to hand over the webinar to Scott from Global X, who will bring us through today's topic on investing in the thematic disruption. I will now hand over the mic to our partner speaker, Scott. Scott, over to you.
Good afternoon. I am with everybody just a couple hours away from Thailand. Had the pleasure of spending last week in Singapore. So from all those joining us from across the region, thank you very much for your time. I am going to pull up some slides here and hopefully successfully share the screen. And off we go. So I am joining from Global X Asset Management. We're a subsidiary of Murray Asset. We were bought in 2018, and we are a US-based ETF company, particularly known for our work in thematics and increasingly known for work in the income area. So we are down a little bit from our peak at 40 billion, as are many of us in the market. But interestingly enough, while I say US-based, many of our most important moves in the last 6 months, trying to take advantage of market weakness, has been in international expansion. And so back in August, we opened up an office in Singapore to support Southeast Asia. We bought a business, ETF Securities in Australia. We opened up an office in Spain to add to our presence in London. And we also went ahead and bought a distribution network in Brazil. So we are trying to bring out the global and Global X. And so the Asian expansion for us is important, as is Latin America and Europe. And I am secretly joined this afternoon by a colleague of mine who is in charge of the Singapore office. One of the things that's unique about Global X, unlike many conventional ETF companies that are simply replicating an index like the S&P or the NASDAQ, we have a research-based model. Thematics often have an element of customization. And so while our ETFs are transparent, we do have a large research team that supports our thematic efforts. We have 36 thematic ETFs that we bring to the table, and a series of income ETFs as well, some offerings in commodities, strategies, commodities and international as well. So what I'd like to do is talk a little bit about thematics, a little bit about the market, and then offer some themes. And I'm going to do that in just a few minutes here. So first off, what is particularly interesting to us about thematic investing, right, is the concept that if we focus on structural changes in the global economy, we have the ability to step not entirely outside of cyclicals or cyclical moves in the economy, but it helps us to look through them into ultimately, even if the economy slows down today, and I'll talk for a minute about why it won't, but even if the economy slows today, there are still trends that are likely to persist into the future. So these are sort of one-off around things like technological adaptation, demographic change, or climate. So as we think about themes, we focus a little bit more on that orange line than the blue. Thematic ETFs have grown considerably in just the last few years. We see both assets and number of funds are growing, which really reflect the mainstreaming of thematics. And I like seeing this because as I think about investing, whether you think about growth value, large cap, small cap, or even sectors, they're all backward looking approaches. They all focus on ways that we used to invest and not where the economy is going and the fundamental shifts that are taking place today that are ultimately going to be ways to make money tomorrow. An example of this and series of fundamental shifts is the way adoption has worked across an entire range of technologies going back over 100 years. And so we see that there's generally a ramp up and then a period of rapid growth up until it peaks out. And so we like to find things, early or mid stage on that adaptation curve, because we think that's where we see the most growth and the biggest opportunity. As we think about how we build themes, we tend to be a little bit more concentrated than a lot of our competitors. And so we think about, number one, what are the big themes that are going on? What are the big structural changes across things like demographics, behavior, geopolitics? What do we have a strong belief in? Number two, is there a universe of companies that we think we can invest in to operationalize or actualize that theme? And then finally, what's the time frame for making it happen? And so, we tend to look at very high conviction ideas that have a sufficient group of publicly traded companies, even if we're going to narrow those down, that are going to grow over the medium and long term, because that's where we think the market tends not to focus. So let's take a look at where we are today. It's obviously been a very, very difficult 2022 up until roughly about 2 weeks ago. Thematics have generally been highly correlated and moved down. And so we've started to see, if we look at the blue bars instead of the red dots, that performance is improving. We've slowed the pace of decline across a lot of growth themes. And we're seeing a little less correlation. In other words, some themes are starting to outperform, and that's good for those of us who are trying to analyze markets and determine where we should go. One thing that has come out in almost a good sense, and we'll talk about this a bit more, is that valuations across a number of growth themes have compressed quite a bit. And it is not uncommon for, in economic slowdowns, it is not uncommon for growth to underperform the broader market for a period of time. And yet, in all 5 of the past recessions, going back to the 1970s, if you just look from the start of the recession to the end, i.e. throughout the period of economic slowdown, while growth part of the way through underperforms the broader market, in all 5 instances, it winds up outperforming. And so this is why we believe, despite some of the discussions about whether people should focus on thematics or perhaps they should take a more conservative route, this is one of the reasons why we believe that, growth will recover and remains an area to focus on. That said, not all growth is going to be created equal, and we want to focus on a few things that we think are critical for driving growth going forward. So the first is, actually, are themes growing? Warren Buffett told us the ways to beat inflation, which is an issue globally, is to invest in things with pricing power or strong sales growth that can beat the rate of inflation. So this is a list of themes, from things like lithium and battery technology to cloud computing to artificial intelligence to the millennial consumer. These are a whole range of themes that show, in fact, thematic investing is delivering on its promise of top line or sales growth. And these are the percentage of companies that grew their sales in the last 12 months faster than the rate of inflation at 8.5%. That is very, very rapid sales growth. And so, the themes, if we were to look at this and across the themes, they couldn't keep up with the rate of inflation, then perhaps we would be a little nervous. But Thematics is delivering on its promise of growth. Now, we hear a lot today about interest rates and inflation and how that negatively impacts the market. And this is just a way to think about the fact that company fundamentals matter. And there's this notion that higher interest rates are bad for stocks. That would be that gray line, the S&P 500. As the interest rate along the bottom goes up, multiples go down. That means valuation compression. And these are average lines. But if we look at something like communication services, where there's a mixture of debt held, companies with a lot of debt, like old telecom, and companies with no debt, like modern streaming services, that line flattens out. And then most interestingly, the companies with the least debt, i.e. they are least susceptible to changes in the interest rate, are U.S. tech companies. And we see that relationship inverts. So not all companies are created equal, and the idea that somehow growth companies are more vulnerable to interest rate increases and slowdowns in the economy might not necessarily hold true, and we should keep that in mind. So as we think about what themes we want to focus on, there are a few variables that I think are particularly important in this market environment. Before I speak to that, though, I do want to offer up a drop of optimism for everybody, because certainly when we listen to folks on TV, it sounds like 2023 is going to be another rough year. And yet when I look at the U.S. economy, there are three things I think are really important in terms of a recession. Number one, labor. Number two, leverage. Number three, liquidity. What does that mean? Number one, labor. Well, it's hard to have a recession when you have a strong labor market, and the labor market in the U.S. remains incredibly strong, with 3 openings to every job opening. 3 openings for every person seeking employment. So what that translates to is strong consumer sentiment and strong consumer spending, and the U.S. consumer is still the engine of economic growth. And so we, as long as we have a strong labor market, that's important. As that weakens, then we might grow more concerned. Let's look over at leverage, i.e. the amount of debt that people and companies have. People used stimulus checks during COVID to pay down debt. And so the average household has lower debt than they did before the pandemic. And companies took advantage of very, very low interest rates, and they stretched out their maturity. So there's not really a problem with leverage. And then finally, liquidity. There was a tremendous amount of both physical and monetary stimulus put into the system. In the United States alone, over $10 trillion. And so there is still very loose financial conditions despite Fed tightening. Financial conditions are just starting to tighten now, and there is ample liquidity on the sidelines of investors, whether retail or institutional, that can come into the market. So we're definitely less pessimistic than a lot of people. We think we're actually on our way out of this economic slowdown. Now, there could be some bumps in the road, and certainly markets don't always move in one direction. But as we think about thematic investing, it might be a good time to mix growth with a little bit of profitability, i.e. let's build in some cushions. So what are we looking for? We're looking for a few areas where PEs, i.e. valuations, have contracted from highs. So the further we are on the left side, the better on this chart. We're also looking for areas of high growth. So that's the forecasted growth for next year, which means the higher you are, the better. And that's sales growth. And then finally, in this environment, we're looking for profitability because we don't want to wind up in a situation where companies do have to refinance, and those that are already profitable with strong operating margins are likely to perform relatively well. And so there are a few things that stand out as we look across. Lithium and battery technology, where we see significant valuation compression and yet expected growth north of 40%. Similarly, valuation compression around 30% for data center REITs and digital infrastructure with high growth. And then over kind of in that middle, there's a dot for U.S. infrastructure development that we think is very interesting as well. And so I'm going to jump into and just talk about each of those very briefly. But we think this offers a mix of relatively strong potential growth. So these themes are looking at sales growth of 15 to 20% or above for next year. And at the same time, while being profitable, they're selling at deep discounts compared to what they were over the course of the past 12 months. Let's look at lithium and battery technology. A big driver of this is going to be electric vehicles. And so that's a hot topic across a number of Asian markets that comes up pretty frequently. And we're really only in the early stages of adoption. But the challenge here is as we ramp up, the demand, right, the number of autos that are going to be produced are going to put pressure on the lithium and battery space. So, for example, the United States in 2021 produced 446,000 electric vehicles. By 2030, that goes up to 2.8 million. So that's almost a 6 times increase. And the gating issue is around batteries. So we think that there's a really strong tailwind behind the lithium and the battery space. And so as EVs come online, and just about every major auto company in the last 24 months has announced that EVs will be a major, if not a majority part of their business, as that comes online, the demand for lithium and battery technology is going to remain really strong. We think that playing lithium and battery is maybe a little bit safer than playing electric vehicles, and certainly safer than just picking a single stock like Tesla. In this case, you've got a basket of stocks, Tesla included, but not the most important of them. You have a basket of stocks that are focusing on the upstream aspect of EV adoption rather than the car companies themselves, which are effectively replacing fossil fuel production with electric vehicles. The second one that I mentioned is around data centers and cellular towers, right? So we think about this as data center REITs and digital infrastructure. And this is another area where we see growth being quite strong. In the first half alone in the United States, data centers, which are the physical location that house essentially the cloud computing drives. And so these are very specialized facilities, air conditioning, humidity. They have to be designed in specific ways. They have to be located normally in specific places. And so demand for that has gone up in the United States 60% in the first half of the year. And as companies continue to spend to digitize, CEOs and CFOs, 70% of them regularly report that the primary area where they will spend their capital investment is in digitalization of their business. And so to the extent that that happens, the demand for data centers and REITs is going to remain very strong. And we can see here, just in terms of, the data center, it's not just the United States. It's a global phenomenon in terms of how much capacity is being added in terms of megawatts. And meanwhile, how low the vacancy rates are in the facilities that already exist. So clearly some areas, particularly a couple in Asia around China, might have overbuilt, but generally speaking across the West, they have underbuilt. And so this is one, again, very, very strong growth expected, very strong profitability. And yet it's tied to cloud computing, artificial intelligence, cybersecurity, all those things that, that we talk about and, are considered high growth themes. This is really the backbone for that. Finally, we talked a little bit about U.S. infrastructure. And so that is essentially, according to estimates, a $2.6 trillion industry over the next 10 years. A lot of people say, well, the United States just passed an infrastructure bill of $1.2 trillion. And so isn't the trade over? This is one of the reasons why U.S. infrastructure sold off. We saw a lot of inflows, if you will, for infrastructure during the period where Biden was just elected, the bill was negotiated, and then we saw outflows because people were buying a rumor and selling the news. But given that this is government allocation, it takes 1 to 2 years to work its way in. The byproduct, the sales growth estimates for many of the companies in the infrastructure space have gone up significantly, even while people have been selling off the theme. So we really like the combination of profitability and growth that we get with this. And since we get it at a 30% discount from its peak, it seems pretty attractive. You might ask where the incremental 1.4 trillion is going to come from. Some of it might come from the private sector in a bill down the line, but a lot of it will also come from the private sector, who might wind up facing matching programs where they can take advantage of some of the government stimulus, and yet there's no way that U.S. infrastructure needs will be 100% publicly funded. Matter of fact, more and more of it is privately funded, and these are people taking advantage of building toll roads, adding to port capacity, and things like that are really critical to maintaining commerce. So as we think about, again, where that money's going, highways, bridges, electrification of the power grid, passenger rail, digital infrastructure, so all things that are absolutely critical to competing in the global economy. There are some other themes, by the way, that we like. And I'll just mention briefly, we do continue to like, let's see if this works. Let's see. I apologize. I'm trying to turn off sharing while we're talking, which might or might not work for me. Let's see. Let's try this one more time. Okay, let's share. And now let's stop sharing. Hopefully that worked. But a couple other themes just to consider as you're looking at adding some potential growth to your portfolio for 2023. One is around cybersecurity, where we think that the growth prospects are very, very high, or so they're estimated to be. Continues to be an absolute imperative to spend for anybody who's digitizing. They don't have quite the same profitability as some of the other themes we've talked about, but they've also sold off quite a bit as things like cloud computing, anything related to remote work came down. Cybersecurity came down with it. We think it's a fundamentally different industry. It's worth a look. And then finally, around automation, robotics and automation, where we think the U.S.-China rift, the U.S. CHIPS Act, continue to support both onshoring of technology, which requires automation in the United States, as well as China facing demographic challenges of serving a larger consumer economy with fewer people. And so we think there's a pretty strong tailwind behind robotics and automation, and they're likely to continue to gain interest as robots move out of auto plants and into other segments of the economy. So I'm going to stop there and turn it back to the team.
All right. Thank you, Scott. That is very informative. We do have a couple of questions from the ground that maybe you could see whether we can address it for them. One is there any other interesting themes with Global X, or maybe something along ESG, as we are seeing
Yeah,
some interest in the ESG investment nowadays?
yeah, it's a great question. So we don't have any ESG funds in and of themselves, partially because, and the U.S. SEC, Securities Exchange Commission, is looking very closely at this, that a lot of the what's called ESG funds use these scoring methods in order to exclude stocks. And so what they wind up looking like is the S&P 500 minus energy.
I see.
And so, they whether they actually are delivering additive versus just constricting the universe is questionable, and the scoring systems are now being called into question. So instead, we've got a whole series of climate-related funds that we think are pretty interesting. For example, we have Clean Tech, which focuses on the intellectual property behind renewable energy. So these are people working on coatings for windmills and more efficient engine designs for geothermal. We've got a renewable energy producers. So these are the utility companies that are focused on delivering energy through renewable sources. And then we've got a series of specialized funds, like, for example, wind, solar, hydrogen, and water. So all of which areas tied to the environmental part of ESG. There's also an ag tech fund that is agricultural technology that is pretty new in terms of our offerings. But clean tech and renewable energy have been around for a little bit. And so those are all ways people that are thinking about playing the climate theme can take a closer look at.
I see. And one more question on the ground is, what are some risk management strategies that investor can utilize, especially perhaps in the US markets or in an environment where if we see volatility persist?
Yeah, so a few things to think about. Number one, certainly as we discussed today, buying assets at lower prices with existing profitable businesses is one way to, minimize your volatility, even if you want access to growth. Another interesting thing to look at is a covered call strategy. And so this is one where the Global X owns the underlying stocks, and for example, the NASDAQ 100 or the S&P 500, and then sells the options on those underlying assets at the money, collects a premium for doing so, and then passes part of that premium, 1% a month, on to investors. And so those premiums are larger when there's more volatility in the market. And so even among volatility, that would mean investors can, see a 12%, payout from the fund. We're not tax advisors. I'm not going to talk about tax consequences for income from this. But and then anything in excess goes back into the fund to buy underlying stocks and be able to sell more contracts. So when volatility is high, that payment on the premium is higher. And then as volatility comes down, the payment on those options goes down, and could be closer to 6 to 8%. But it's very interesting to match with a thematic strategy, because when volatility is up, your covered call strategy is down. But typically when volatility is up, your growth stocks are down. And then as volatility goes down, because markets begin to rise again, growth stocks typically outperform. And so, but your covered call strategy will generate less income. And so it's a very interesting way to balance out volatility and growth?
Thank you, Scott. I think that is the two questions that we have on the ground. Thank you for your very valuable insights and, of course, this very interesting and informative session today. And big thank you to our audience and for their participation. We hope that Scott's sharing today is useful. And when it comes to your making a future investment decision, you can also consider looking at the screener again on some of these instruments that Scott mentioned earlier, including, of course, the renewable energy and the lithium batteries ETFs offered by Global X. So I'd like to end off this webinar by introducing the Saxo's account plan. If you haven't already get yourself familiar with it, Saxo recently launched this new account pricing that allows client the flexibility to change your pricing monthly depending on trade requirements, lowering trade commission and offering other perks. So alongside with securities lending, custody fees is discounted or even waived with a potential to earn extra revenue on existing securities. So if clients who do not have an existing account with us and can't wait to take a closer look at what ETF Global X is offering and the ETFs that Scott mentioned during the webinar earlier, do visit Saxo website. In the top right hand corner, you can open an account. It takes about 10 minutes to complete the application online using your SingPass MyInfo. So once again, thank you, Scott, for the very insightful sharing. If you have any sales inquiries or any feedback regarding to this evening's webinar, do drop us an email at ps@saxomarkets.com. And this webinar is also recorded and will be uploaded to our social channels and, of course, onto the Saxo platform and our website within 1 to 2 business days. So you can scan the QR code on the page to access the Saxo webinar recording within the next couple of business days. Yeah. So with that, thank you, Scott, and thank you all participants for your participation today. Thank you and have a good night.
Thank you.